Welcome, ladies and gentlemen, to a Grey Market Talk in an exciting week with a former market maker for equity options. So I might have to say a word or two. That would be me. And how would I describe you today to pick you up the most? The fantabulous Chief Investment Officer with over 80 billion assets or under his belt to manage them in all asset classes, who used to be a market maker himself, worked for the big names in banking we have there, and who takes the pleasure every week to explain how markets really work to a dumbo like me who just wants to push a button. Is that correct, Nic?
Yeah, you missed the golf, but apart from that, it was pretty good.
All right. So obviously you've all seen it, yeah. Murad and I produced on Sunday last week before the second shoe dropped a video, 1.5 hours. If you haven't seen it, please have a look at it. It's very interesting because we pretty much analyzed what might happen, and things actually happened that way. Not surprisingly, because if you look at markets in a certain way, you could expect certain outcomes. That it works out so nicely, well, sometimes you also have to be lucky. Yeah, that's why you have to be in this market. What Nic and I want to discuss this week is actually, because you heard it as well as we heard it, explanation for it. What was the first explanation everybody came up with, Nic?
The yen. I think they jumped on the yen.
So everybody's talking about the carry trade, right?
We want after the event. Yeah.
Yeah. Well, we spoke about it how many weeks ago here on this channel?
It was at the high.
Yeah.
And of course, the carry story has been around for some time, but there is, and I think this is what everybody missed, even in their subsequent sort of post-event explanation. Why was that the time exactly for, this thing to blow up? And I think that's an important bit. So go back to our videos, and the story is there. We won't necessarily repeat it now, but that's an important factor in all of this, and it kind of explains in some way what might happen next.
Then we want to have a look into, which everybody knows now, the Sam rule, Claudia Sam, economist, which became suddenly very popular. A woman hardly anybody had ever heard of before, and now it's in everybody's explanation for why suddenly the economy starts grumbling. And then the third part, which related to my work, well, my line of work, the so-called dispersion trade, and batshit crazy stuff volatility did, because there are a lot of things you see on the surface, VIX trading at 60, but then there were also some things which I only noticed, and I haven't heard a lot talk about it, the spread between the VIX future and what the cash market, the VIX, actually did. And I think there are a couple of things you can read out of that. Then we're trying to put it all together and give you our best idea what might happen in the future. No clue, but we have an idea how to approach it from our way. So let's dive right into it. Nic, for everybody who is not a market expert, quickly explain the carry trade again. What does it actually mean? It's in everybody's mouth. Everybody's talking about what is a carry trade.
I think the thing that everybody kind of understands really is when, European investors used to get their mortgages from, by borrowing money in Swiss francs, as it was. It was like low rate of interest until the Swiss franc started to rally. So you borrow money somewhere cheaply and you go and invest it somewhere where you can get a yield. And in some respects, that's effectively, with the Japanese who have had, 30 years plus of very low interest rates and very low returns and very low growth and deflation and all of this stuff. So, they need money to support their aging population. So what do? They say, okay, well, we've got a great idea. Let's go and invest the money overseas. And how should we do it? Should we borrow dollars before we invest in the dollars? How should we hedge this thing? Should we not? And that's basically where it all starts. If they only have a choice of investing in the Nikkei, which was for 30 odd years going like this, from 40,000 plus down to about 15,000 or 7,000, I think it got down, was low, or JGBs, which were yielding, sort of always going down in yield, down to about 0.5% or whatever it might well be, then you say, well, I can't, as a life assurer, get any return for my investors. So what do? I have to go and invest overseas. Well, I'm not a natural producer of dollars, so I've got to go and borrow those dollars. I've got to go and sell my yen, as it were. So I've got yen, I've got to sell my yen and got to sort of buy some dollars with this thing. So you're borrowing effectively the yen to actually lend or invest, I should say, in the US markets or in overseas markets.
Does it mean you were actually forced into that? As a Japanese, you just said the insurance company, yeah? You have to pay out for all your old geezers in your own country, so you need returns for that. You can't get these returns in the Japanese economy. So you simply say, okay, fine, I still have to pay out all the old guys who eventually will retire. So where do I get my money from? So I simply go out and say, fine, I need dollars to buy that. So I have to sell yen, buy dollars with it, and put that into US treasuries because they yield 5-6%, which will just do me fine.
They didn't have a choice, right? And now you see it's the kind of the obvious trade for everybody, or has been, that they have been, very big buyers of Turkish bonds and Mexican bonds and stuff like this because they yield so much. And, for them, that was kind of a no-brainer trade. And until, something happens where they need to sort of get their yen back and they start to lose money because of that, because the yen starts to rally. On the one hand. And
can I ask you, there's the one thing I haven't understood. So interest rates in Japan are basically, let's exaggerate, still zero. Yeah. Now they're talking about, we are going to increase our interest rates by 0.1 or 0.2%. Yeah. And in America, you still get 5% at the short end. What the fuck? So really, is that why people would, and that was the explanation, why people kill their carry trade, or what's the real explanation for that, Nick?
The real explanation at the end of the day is if you're shorting the yen, it's all very well until the yen rallies. So if you sell yen and you buy dollars, you are okay whilst the yen is falling. And it's been falling and certainly not rallying. And it's been an obvious trade bit for the domestics, certainly. And it's not just the domestics. I mean, the hedge funds also do this thing, right? So it's okay. Why? Because the government in Japan have said for years they are just going to print and do super QE and all of this stuff.
I like super QE.
And yeah, and so when you look at that, you say, well, I mean, the yen's not going to rally when they're just going to print, right? So they're not getting inflation. They're going to continue to print. The yen's not going up. Surely it's a safe bet. And it kind of is for a while until it's not. And the point is, and this was the trigger and the reason that we spoke about it weeks ago, was because the yen had reached a critical level. Now, two things that were, for me, important at the time were that, number one, more likely you're going to get Trump. He doesn't care whether you're Japanese or Chinese. If he thinks you're manipulating your currency, then, you're going to pay for it. Tariffs and stuff like this. So, they've got to think about whether or not they can continue to allow weakness in the yen. So that's point number one. It's not necessarily the important one, but more importantly is that when the yen got to 160, above that, there was just such a level, 180, 200 versus the dollar, that actually this is now free fall. And when a currency is in free fall, then we're talking about a different problem for the economy, because then your yen is absolutely worthless. Then rightly people will say, well, it's just a piece of paper. What do I need this stuff for? And I'll go and buy something else. And I go, you know what? And this, you've got really an absolutely different problem when people start to lose faith in the currency. So, and it's obviously, the weaker it gets, the more expensive stuff gets when they import oil and they import gas. They're not natural producers of energy. They've lost their sort of export surplus that they had years before. So actually the yen became an important factor for them. And this 160 level, for me, was the line in the sand. And it got to 162, but not for long. And intervention, talking and stuff like this. So something had to happen. And my view at the time was, as we were approaching this thing, and I was saying to, my institutional client, that effectively, at the same time, you were reading stories, stupid stories. Norinchukin Bank losing money by buying treasuries. How did they lose money by buying treasuries? Well, we know, like everyone else, they held these things. They went down in prices, interest rates went up. So they started to lose money. And then the CEO of Norinchukin says, hey, I've got a great idea, better than the last one. I'm going to buy some dollar CLOs. I'm going to sell my treasuries, 60 odd billion dollars worth, and I'm going to buy credit in America. Why? Because I'm still mentally thinking I've got to go and buy foreign assets because, why should I invest in Japan? For a Japanese bank CEO to say that, kind of publicly, naughty. And I thought the government would literally pick up the phone and say, right, forget all of that nonsense. If you sell your treasuries, you're going to buy something domestically because we need that flow of money back to support the yen, because we can't support it anymore, because the market doesn't believe us when all we do is just, we sort of promise intervention. Everyone knows we're going to run out of firepower. So repatriation as a strategy became very, very important. And coincidentally at the time, the government pension fund, which has a 1.5 trillion assets under management, said for the first time in 5 years, we're going to do a reallocation of our sort of assets. We used to just not just buy JGBs and Nic and I, but we also bought S&P and we also bought bonds and treasuries. Now we're going to do a reallocation. And my view is they didn't decide to do a reallocation. The government told them they're going to do a reallocation.
Is that what happened at the beginning of this week when we suddenly saw the miraculous recovery in topics Nikkei 225? Was that the phone call by the Bank of Japan to the pension fund saying, you're buying ETFs now, friends. We're not going into a tailspin here and build out a 40-year double top in the Nikkei 225?
I don't think they've begun their trade yet. So we haven't seen that yet. All we have seen is words to scare all of those people who decided to short the yen and say 160 on the yen, we ain't going to let this thing go down. So if you're short, just to let you know, there's this 1.5 trillion fund over there that's going to do a reallocation. Do you really want to stay short? And I think these sort of investors, traders, hedge funds, whatever, I think we've just seen the first wave of this thing, and the government will kind of blimey. And I think the blimey factor was really because everyone's on holiday, so it probably doesn't take too much volume to shift the yen that much in such a short space of time. But I think this is the beginning of something. I don't think I've heard stories of this Wall Street bank suggests we're halfway through. Don't be daft. We have not even started, right? I mean, this is
JP Morgan came out this week and said 75% of the carry trade. Yeah, fine, but they're going public with it. But I think fire to the feet. Hold their feet to the fire, right? So 75%, according to them, of the carry trade they believe is done, dusted, has been dissolved.
And if I were JP Morgan,
I would say
or someone large, right? For example, a hypothetical bank, ABC Bank, of equal importance in America. I also don't want to see turmoil with the dollar, with the investment market. So I might sort of put in a phone call to the sort of lowly analyst over there and say, I actually think they're halfway through, or maybe even 3/4 of the way through. What do you think? Oh, I think so as well. Thank you. Right? And you get these stories come out. Right? And I just don't believe them. Okay, so there's no way that a government pension fund could make an announcement that they're looking to do a reallocation and suddenly, like a few weeks later, oh, no, it's done then. It doesn't work like that. It just doesn't work like that. What we saw were just the punters who had shorted the yen, bought NVIDIA, bought whatever they've done. They read the same articles that I did, which came out on Reuters and all of this stuff. And those were Have you had a look at this? I'm not going to stay in that position any longer. And I think that's really what happened. And it happened at that critical level at 160. That's why it happened then. That's why it didn't happen before. 160 was, for me, a line in the sand. So, halfway through, never. And I think the Japanese have only just begun this process of repatriation. I think it's very important for them to think about, actually. And this is one thing that I think is going on in general. I think sovereigns are more interested in their domestic savings institutions putting more money in domestic economies than previously, saying, oh, I'm a UK pension fund, and I've got, X% small in UK, because what do we do? I'm going to go and buy some US stocks and some European stocks and go out there. And what happened is the government have kind of announced that I think from next year, they have to make public in their sort of statements what percentage of domestic investments they have versus what percentage overseas investments they have. And the moment you make something public like that, politicians, you've got to love them, they're going to read it and say, why is it that we're allowing our sort of, we're not investing in our own economy? Could you please explain yourself? So the leading pension funds have basically, I think, and I can't remember the number, they said, okay, by 2030, we'll invest 50 billion. It's probably a wrong number, in the domestic economy, more than we're investing in today. It's important because, as we said, for the American sort of who's going to fund the debt, more and more domestic institutions, I think, this is the same thing for other economies, Japan, UK. You're going to say, right, well, the first place I'm going to look for my funding of my economy and for funding of my debt is the domestic savings institutions, because they're really important. And I can force them through transparency, force them through, a newspaper article in one thing. And I think that's what's likely to happen. Continue.
Also, you just mentioned the financial institutions in Japan. There are also rumors going through the market that they're in a really bad shape financially.
Yeah. So it depends on which ones you look at, right? So this government pension investment fund is called, this is a 1.5 trillion investment fund. So it's, I don't know, it's the equivalent of the Norwegian, sort of sovereign wealth fund. Let's just say it's not actually, but let's just say it's very large. And this, this organization last year showed profits. Was it last year or last quarter? Can't remember. $280 billion profits. Now, why? Because they invested overseas, they invested, in equities. And that's a really important statement in itself, because, we want European organizations to invest in equities of their own country instead of not. So they are making money. But when we look at Norinchukin Bank, right, we know they lost a lot of money because they bought treasuries at the wrong time. The yields went up, the price went down. Part of their thing was hedged, and we know that when when the interest rate differential was so much wider, and the dollar was so strong, effectively, that the hedging costs totally ate up all of the yield, the 5% yield on the treasury bond. So it's now negative. Yeah, if you want to buy treasuries, you're paying 2% plus. Negative. If you're a Japanese investor hedging it back into yen, so you say, I don't take the currency risk. So what happened was, as the hedged return went down, these guys basically said, okay, we're going to run it unhedged. Kind of makes sense. So you now got, really smart. So firstly, Norinchukin Bank, wants to go and buy something which covers the hedging cost. And then secondly, you've got these guys saying, okay, I've got a great idea. I'm going to unhedge it. And then when you unhedge it and you think that the yen has just moved 15% or 10%, let's just say, in the space of 2 weeks. Whoa. I mean, that's back into yen. What's the value? I mean, you really have to think about it. So these guys have to be nimble. And when you are in a large institution, the last thing large institutions are is nimble, right? So that's a big problem. And everything works hunky-dory when it's all a straight line and the yen's weakening a little bit like this and nobody really cares. And it's sort of, but when things start to move and when the Ministry of Finance say, we can't afford the yen to collapse here, that's when you've reached the point of, shit or bust, as it were. And at the moment, that's what's making the whole system very vulnerable, because now the yen's down here, you've got the whole market cheering. Oh, the yen's gone from 143 weakened to 147. What a brilliant thing. Be careful what you wish for, because the other way as well, when you go to the 160 and above, all hell's going to break loose. So what do you think is likely to happen? You're far too leveraged, and this leverage does need to come down. So, but for the people who say 50% has been done, don't believe it.
Well, they still have this beautiful tradition in Japan of called it's seppuku, right? You take a sword and then you go left, right, and all problems are solved.
It's just, yeah, I mean, but that's not really a solution thing, because the next guy who has to take over the portfolio has got the same problem. And this is, it's absolutely fascinating state right now, because then Fed say, okay, obviously now I've got to cut interest rates. So then you had this sort of lunacy of 2 lots of 50 base points in one go. In the same lunacy, they shouldn't have put rates up so much in the first place, but you got this sort of panic, knee-jerk, got to do something. They had all the time in the world to act. They had all the time in the world to basically sort of ease up on the rate hikes much earlier. Okay, let's just say they missed that, and then say, oh, actually, it's going in the right direction. We're going to do a 25, and we're going to sort of see how it goes and begin the process. Now it's emergency meeting, possibly, which I don't think is happen, and the next call of 50 basis points. And I had a target on the December 25 Euro, the SOFR, so it's the old euro dollar future, for people at our age. I had a target of 96.5, and that was when it was like 95.75. This thing just went zoink all the way up to 97. That means people are expecting 3% for 3-month rates, by the end of next year. Well, we may well get there, but I'm sorry to say that the expectation shift from suddenly where we were to where we are right now is far too extreme. And it just goes to show how vulnerable this market is and how leveraged this market is, that people are so scared that the top bank in the country comes out and says, oh, don't worry about it. I think it's all done now. I think it should be. That was
a surprising point. So we mentioned that before. We have an unstable equilibrium. Yeah. The ball is on the top of my hands now. It's not in the fold. So fast forwarding it to the end of 2024, I think, which is the most interesting point. Where's your take on that? Where does it take us? If it's not over, if it wasn't a head fake, it was clearly the first tremor of a far bigger earthquake. And the Japanese have experience with earthquakes as well, right?
Yeah, indeed. And I am of the view that this thing is normally these things, they come and they go, like they were with Silicon Valley Bank. Yeah. And then suddenly with Silicon Valley Bank, you had all of these experts on YouTube come out and say, oh, that bank's next. And then we had this sort of few banks going, and then you had this sort of real estate thing. And then you get a lot of people, but none of these things ever created enough turmoil in the market to be long lasting. I think this Japanese thing is long lasting. So I think this is not something that goes away overnight. Whatever you hear from these experts, this thing is part of I think, policy. And if it's not policy in Japan, these guys are going to struggle, because they really do need to make sure that their currency, above all, survives. And it was not enough for the Bank of Japan. It was okay. Nice cheapening currency kind of helps your exporters, and nobody really notices, and a little bit of inflation kind of is not a bad thing for a country that's never had inflation. Although, why it's good to pay more for oil, I'd never understood. But anyway, let's just say they're all happy with that little bit of inflation, little bit of a weak. but they can't accept a collapse, because a collapse basically takes them into the Argentina territory, and then it's a different ballgame, because then they ain't going to jack the interest rates up 10 base points or 25 base points. We're talking about a different big figure to try and protect their currency. That's what they must avoid at all cost, and that means they need confidence. And it doesn't show much confidence if the domestic saving institutions of your country are investing somewhere else.
So let me get in there, because now you've explained beautifully that we've seen the first pinprick, and most likely there's more to come out of that region. How does that hit the markets you and I are most engaged in? At least I'm most engaged in the US market. When moving to the next topic, if a recession hits the United States while Japanese market is draining liquidity out of the United States, then we have a double whammy coming, right?
Yeah, and that's the point, really, isn't it? How much do they need to do in order to make sure that the yen steadily improves, and not just these jerky moves? The skill of the policymakers in Japan is when they do this and the yen starts to strengthen a little bit and comes back to a level which everyone is comfortable with, where Trump doesn't say you are manipulating your currency, where the people of Japan, say, okay, I'm getting some value for my currency now, instead of every time I go on holiday, I can't afford it and I've got to stay here. So you need to find that level, but you need to do it fairly slowly and smoothly. But you need to show the market that it's going in that direction, because you need to take all question about the survival of the currency off the table. And that's your job. And we'll see whether they succeed. But in the meantime, the markets that we love over here, it's very important how they do it, because if they do it slowly and gently, then you may not really notice. But my feeling is that when you take an investor group disinvesting, then you need someone else to replace it at the end of the day, if you want to carry on the same kind of vigor in your market. And I can just see things. I think, how are we likely to see the effect? I think we're likely to see the effect through slightly, and I really do mean slightly, lower multiples rather than the multiples we have today.
So the carry trade in everybody's mouth, or in everybody's focusing on, is merely a symptom for a change in real policy that's going to happen in Japan. And that is not just, we've unbound 75% of the carry trade. It's something which, if they do, as you just explained it to us, means there's more to come.
I think so. And I think it's policy. And I think it's not just more to come from the Japanese. I think it's more to come from the Brits. It's not really carry trade, but it's kind of the same thing when you say, I'm not going to invest in the UK, I'm going to invest in the US, and I'm not going to invest in. So when you start to reduce that, and you say, okay, whatever it was called, this global diversification thing, I think this global diversification thing is becoming less diversified and is becoming more domestic. And that is driven by the same theme that we've been discussing for the last years, that the government's debt and deficits need to get funded somehow, and the only way to do that is to rely on people that you can control rather than people you can't control.
So you can control your own public. So let's come to the U.S. economy now, the SAM rule. SAM rule simply says we've reached now, through a technical indicator, an unemployment level or job losses, which in the past always ended in a recession. The wording is 0.38% over a 3-month moving average. Details don't really matter, but it's in everybody's mouth, and everybody says, ooh, now we see the employment market in the United States actually showing signs of deterioration, which is usually the last sign before we hit a recession. So if the Japanese are draining the US market of liquidity, and in the United States we're actually now, and we always disagree about that, I think it's going to be a severe recession. You think not, or not a severe recession at least. So we have no liquidity coming in. Not no, but we have lower liquidity coming in from the Japanese side. In the United States, unemployment rises, which means people have less money to spend. The delinquency rates in credit cards are sky high already in the United States. When we see last week, we saw the unemployment figures and they came in better than expected. Yeah. And you just click up the charts and think, okay, show me the revisions. The numbers they show you in 1 month always look, oh yeah, they're not that bad. And then next month, the revisions are, oh yeah, actually we had 50,000 people more unemployed, but nobody looks at the old figures anymore. And then they play on this game up in a perpetual cycle almost. And I think what we are seeing now is, or what the market got spooked by, this came together, the Japanese part, plus maybe good old Thorsten might have a point that the so long called recession and all the good old indicators now actually start making sense again. Yeah, we have the inverted yield curve, and the talk was always, oh, the moment we get inverted, we have a recession. No, when it uninverts, when it gets a steepener in, that's usually when the Fed starts lowering rates for the first time. Then the equity market usually takes a dive. Did it in the past, and I think that overwhelmed the market as well, until it didn't. We saw that at the beginning of this week, right? We have this panic, and then we have a turnaround Tuesday, and then we have a slightly weaker Wednesday. And on Thursday, Friday, we're taking all stops out and say, yeah, with Hosianna into the weekend. So where are we there now?
If you read a rule on one of these sort of YouTube channels, then it ain't going to work, right? Everyone's saying, oh, the yield curve inversion, right? You know, doom and gloom and disaster. I mean, I've heard that from so many people, and very odd, they seem to, but people love that kind of thing. I mean, let's face it. I mean, people do love it because we watch it, we see these 100,000 plus viewers for a doom and gloom, wrong, incorrect forecast, which kept people out investing in the booming stock market. You know, good luck to them. If they like that kind of thing, then I can't help you. But you know, I'd say on the SARM rule, I actually sort of I've always watched the SARM rule, and I do think it's important because as you say, the sort of the times that it's wrong is so rare. I think it was wrong once in the 50s, 1950s, right? So we're talking way back. And it's very similar in, I think, to the rule that you told me. You sent me to an interview with Jeff Grundluck, who came up with the moving average on the unemployment rate. Sorry. And in this respect, this is very similar to that rule. But as I said to you before, I think the reason that the unemployment rate is sort of looking so dodgy is because of the what do you call it? Doorbell. All live. It's all live. Because the what do you call it? The immigration, mass immigration that's come here. So, and I think that's why you've got these numbers which are somewhat distorting SARM rule and the moving average of the unemployment and so on and so forth. So, in this respect, I think I would treat that with a pinch of salt for now. But people weren't just looking at, you know, the recession thing. I think, you know, they wanted to look for something. And when markets are really bad, they'll go and double up and say, oh, look over there, it's really awful as well. And you know, let's look at something else. And I just think that's a bit misleading. The thing that I would look at for the economy and is it safe or is it not safe is PCE. So as long as people are still spending, then they can't be worried about their job, right? So I think that's pretty important. You know, is the Fed a bit late with their rate cuts? You know, are interest rates important in the first place? Well, as we discovered, they're not really, because they put them up, nothing happened. You know, it's that classic sort of thing I wrote about when I said fall in the shower, where you turn the dial and then nothing happened. They turn the dial even more. And then suddenly you reach a point where it might matter. And I think the moment you sort of got to this extreme level, which I think was ridiculous what they did, you know, there are going to be consequences which we don't know yet. Yeah, we don't know where they're going to actually pop up left and right. But I think in this respect, are the Fed late in cutting? I think, you know, yeah, they are. growth isn't that great. Yeah, I mean, if you look at real GDP, it's about, 2 and a smidge. Not really brilliant, and that doesn't really justify 5%. I mean, what are you doing?
So let's put it that way: the Europeans would kill for 2% growth because Germany is now dripping back into the recession, and I wanted to actually weave that in. Can we actually have a growing, or resilient United States economy with Japan? Europe sucks the big one. Germany, still the fourth largest economy in the world, is in an absolute catastrophe. Right, we have global tensions coming in. Everything which made, when we started our career, made us as economies wealthy was free trade, no war, and people moving from A to B to make some money, and socialists were put back in their little cupboard because the Soviet Union just defaulted. Now this all seems to have reversed, and the biggest point I find interesting, whomever you talk to of the kids who do not have gray beards, nobody can actually conceive of a real recession.
Yeah.
It's like, it's not possible. The Fed will come in and we'll all, there might be a little drop in employment, but then it will always go up. It will always grow. But the circumstances are not there anymore.
And partly the reason is, firstly, the reason is central banks don't understand the economy, and they think they do. And because they think they do, they say, hang on, when something's sort of happening over there, they say, oh, I've got my sort of tool, which is the same tool they always use. And they say, oh, it's an interest rate tool, right? And so they sort of say, okay, well, I'm going to fix that problem over there by turning this thing to the right. And then when it goes a bit wrong, we're going to turn it to the left. It doesn't work. Right, so their understanding of how the economy functions is just totally wrong, and therefore you get sort of, if the models are wrong, then obviously the kind of the way that they try to fix things not going to work either. Then you've got the other problem is that I think we move more and more to the point where the governments and politicians understand the value of controlling and influencing people's lives with handouts, and therefore they say, I become a more popular politician by promising 2,000 a month to let's just say everyone in my country, and I'm going to be sort of go down in history as a really popular leader. I mean, of course they never are, because there's still a humongous sort of spread of wealth, and people are still living in poverty everywhere. So I think these two factors of the promise of always sort of the government coming in there as the last resort is a good thing in some respects, right? But when you've got a central bank that doesn't really know how the economy works in the first place, they just mess things up as well. And, that combination, I'm afraid, is really bad. So I think, I've always said that I think central banks will lose their independence. They have to. There's no way that the government are going to allow these guys that much control over the economy. I think that just is we'll see it one day. I don't believe that they'll maintain that.
Yeah, but then we have this scenario, the moment governments, who are usually less capable even than the central bankers in making decisions. You have a scenario to be long mega equities forever, because that means inflation will come, will stay, will increase dramatically. And well, if you go from Weimar Republic to Venezuela, having been long the equity market when real inflation hits you was always a good decision. You were invested in real assets.
Well, that's we haven't talked about the other market yet, and that's the bond market. And obviously, what we saw during the week was something that I've been waiting for and something I've been calling for, but it happened so sharply. And you just think, okay, I mean, are you serious? Is this really a proper market? But basically, so yields were at 5%. We said buy them. Yields then went down. Then had this because everyone was forecasting 6-7 rate cuts at the beginning of the year. Yeah. Then when they realized they weren't going to happen, the yields went back up to 4.5%. When they went back up to 4.5%, I said, you've got to buy this thing. Target is between 3.5 and 3.75. And, we basically got there last week. Okay. So what do I say as a kind of advisor to somebody on this, I'd say, well, you're at the top of the market. You know, fine. The last 25 base points don't care. You know, maybe there's a bit more of an extreme move in bond yields because people get a bit excited about this, that, and the other. I'd just say stay off them. You know, why would they now belong in my portfolio? What advantage do we have by having these sort of fixed coupons at 3%? When we said at the end of the day, you know, more printing, more this, more that, more, you know, I'm not going to produce in Asia, I'm going to produce domestically. That's going to cost. I'm going to shut my borders to immigration. So I'm going to stop the opportunity, if you like, of cheaper labor, or at least put a cap on my wage rises. And so wage rises are going to go up, kind of rightly, you know, finally. But at the end of the day, inflationary. With all of that, why do I need a 3% coupon if it gets there? You know, for what point? I'm waiting for the move down. We saw the move down. Okay, goodbye. Take that, you know, market out my sort of eye, and still short end for parking money, but more than that, it's not.
So we've now 3 points which actually start sucking. A future lack in liquidity coming out of Asia. Yeah, what is true for the Japanese is in a way true for the Chinese, and well, the Russians. They're not buying anything anyway at the moment, and also for the oil-producing countries. Then we have a deteriorating employment situation in the United States, which is, you know, it can't get worse from this level. Otherwise, we do not have a soft landing. We're really now at a point, if it dips below that, the soft landing narrative is out of the window. Everybody knows it's coming. So we are really, really crucially now here at this point. And then the point you made about the bond market, spot on. Yeah. If inflation is creeping back in, we have the third nail in the coffin to say, wait a second, why would I want to now start investing right here? At least not in US bonds, because that was it, or that might have been it. Why would I go into the equity market? I would only, we had this in our special podcast on politics, yeah, about President 43 or 44.
The only 48.
Yeah. The only
it's inflationary. It was 43 or 44 at one stage.
Yeah. Yeah. Now, the only thing then that would entice me is really a Harris presidency, where they put on the printer and then you buy all the friendly billionaire stocks. Because, hey, they will get the money, they will get the orders, they will get the jobs. Yeah, stuff the small man on the street. They don't care about them anyway. Who do they care about? The guys who control the media. Who are these? The Sachs and the you name it in there. The only guy who's playing against them is Elon. And they'll try to finishing off one day as well, without any doubt. Yeah?
Growth is is too. I mean, everyone focuses on growth as being the solution to all of this thing, and you know, whether it's GDP or GDP per capita, which is a much better kind of measurement. But it's really it's a problem. It's a problem for China. It's a problem for other Asian economies. It's a problem for Germany, right? As they change their business model, willingly or unwillingly.
They change their business model from doing business to not doing business.
Yes, so they changed their business model, and they changed the rules of engagement as well, and all of this stuff. You know, they stopped focusing on the consumer and they started to focus on something else. So you know, center of Europe, right? Growth is a problem. The Brits, you know, there won't be many riots, believe me, if people felt that the economy was in, you know, good shape. And, you know, this number here and there of a week is neither here nor there. So you've got a situation where around the world, whether it's sort of, you know, populism or whatever you want to call it, is driven by the fact that there isn't enough growth. And the problem is everyone's trying to find that solution. What's that right formula? And one thing that the government knows is the right formula is not to use money which should be invested in the domestic economy to be used overseas. And I think that's kind of the change that we're seeing right now as everybody kind of tries to look out for themselves.
So it's the old Kim Jong-un was right. Yeah, it's the Juche principle. We should be able to do everything on our own, from food production to energy production, and be a self-sufficient little continent state or whatever. And that is the point I made earlier. All the kids have forgotten the wealth we are living in now was free trade, open borders, no wars.
Yes, and
we're chipping away everything.
We talked about self-sufficiency. We talked about, do you have your own energy source? Do you have your own food source? And if not, what are you doing to actually achieve that and secure it where you have to get it overseas? And, those were the, basically, you've got one job as a government.
Yeah.
That's it, right? So that you can function as an economy. And we veered off the original topic, but it's part of the same theme that the Japanese need to look after the Japanese. And this currency was reached the level.
Yeah.
And so please repatriate. You've got to look here first before you look over there. The Brits, they already began a while ago. And I think that should be and will be a theme, recurring, underlying for many years to come.
So we have fundamentals do matter. Yeah, we're seeing that right now. Building a picture and saying, okay, what's happening to the economy? The stock markets will eventually, before even the economy realizes, take that initial step. We've seen it before, see it again. So the question how I'm going to title this video, buy the dip or sell the rip. Where are we, Nick? Are we going now to buy a dip, the elusive dip, which if you look last week's trading, made completely sense to buy the dip? Or are we on a bigger perspective selling the rip and say, no, that was it for a while? All quantitative statistics even say if you've seen a run up like we've seen over the last 20 years, for the next 10 years, you actually should expect subdued returns on the equity market.
So we were right at the top to say sell.
Yep.
You found the low.
Yep.
The point to cover shorts, and we kind of we bounced off that, not hugely, but we probably bounced at a significant level where you might say, oh, that might have been really a significant low. However, I still see the path of what we went down was, in Elliott language, Elliott wave, that is, 3 waves. And 3 waves means it's finished, we go up to a new high. However, the rally up has not been in 5 waves. So far, we also only have 3 waves. So therefore, the jury is out. I'm still running my core view, which is, until I'm convinced that, we've seen it really, truly a significant low, then I'll change my position. But I think that the move up has only been in 3 waves, and therefore we haven't done enough to convince me that, this thing is, that the rally is telling me that was the low, and it would go straight up to a new high from here. I don't think so. But every other analyst I see out there basically say, okay, that was it. Maybe I'm wrong. But I think the jury is out on the quality of the rally that, to tell me that was the low and, you should have bought it.
Yeah. No, with all the points we made earlier, I'm on the bearish side. I think the rallies we are seeing at the moment are bear market rallies. We're already in a bear market. Question is it a minus 20% correction we see from the peak, or is it a minus 50% correction we see from the peak if the recession hits the market? Liquidity is being drained out of the market. Why is that so important for me? It's called the tactical brief. Yeah, I like tactical trades. To set up good tactical trades, that's what worked for us over the last week, was to get a general idea in which macro environment we are, and to say, okay, this is a top and this is a low. And then I look at the technicals, and that's what we did during the week, to say, fine, if we have a market where all serious investors are basically out for the time being, yeah, you have a large hedge fund or a large pension fund, and volatility is trading around 30. You don't invest at this point in time. Yeah, you can wait a little bit. Only the really brave guys then say, "Oh yeah, I always wanted to get some Nvidia at 100 when I bought the last one at 135." Yeah. So it was a technical market where the market makers, people from my profession, were in. And you could actually see the levels in the market. We spoke about that on this channel and on other videos before, the gamma levels. They actually did indicate when the professional players had to do certain things to hedge their positions. This works in markets when the big boys are staying out, who can simply override what we are doing in the short term. And that is now what I'm trying to pick up, to say, fine, I still have these levels are indicated in the market, but it's a huge difference if I, like at the beginning of this week, bought the dip and then sold the whip. What am I going to do next? At which levels, if I want to take on a position again? Is that the scenario now where I say, yeah, fine, my models are reliable on the downside, or my models are reliable on the upside? At the moment, I don't have an idea about that. Yes, I think we are already in a bear market. We haven't seen it. Simply, if I look all over the world, with Germany being in a recession and being in a recession now for a year, they were tinkering with the figures anyway. We all know that. Yeah, you see what's going on here. Seriously. Japan not doing so well, China not doing so well, in America, numbers coming down. Where on earth is the growth coming from? Then the earnings will contract, and it's more the question 20% or 50%. And to completely violate my own point, I have to put that on. I put this chart in later. There was an excellent chart coming out. You probably had it in your inbox as well. It was whenever CNBC started their shows on television with market turmoil. Since they do that, the market 1 year later was up at least 10 to 15%, and they were positive. So with this indicator, my negative connotation on the market is obviously complete bullshit, because we've seen it again, market in turmoil, and that is awesome as an indicator. I put it in here on the screen, so take a screenshot if you haven't received it. It's just fantastic. So we see we are in one of the most exciting weeks I have ever experienced in August. It's usually the dull month, isn't it?
Yeah, absolutely. It is normally a dull month. But I mean, you mentioned something. We didn't talk about earnings. I mean, obviously there is a company called FactSet, who every week do a good summary of what's come out, and where the earnings forecasts are and analysts' expectations and all of this stuff. And it's very public. It's on their website. And the expectations are still of for the quarter around, just under 11%, so 10.8% year-on-year change in earnings. But for the year 2024, it's just above 10. So, and for 2025, the analyst expectations are for a rise in earnings of 15%. Now that's pretty stonking. So if you do the maths and say, well, we began the year at around 4,750 in the S&P, dividend yield 1.4, earnings of say 10, right, for the sake of argument, and even if you lose a bit on the multiple, you're still going to be 10% plus higher at the end of the year than where you were at the beginning. So 4,750 plus 10%, around 5,250, kind of where we are at the moment. And then for next year, right, and this is why it's important about sort of bear markets and stuff like this. If you do the same maths for next year and you say, okay, well then 5.3 thousand in the S&P end of the year, and then you add 15%, this 1.4 and say multiples don't change. That sort of takes you close to 6%. So it does show that potentially still there is, expectation even after this week, where the phone calls from the the CEOs when they talk about their earnings, their outlook is not negative at all. So they're not saying, "Oh, Samra, better sack a load of people," and stuff like that. They're basically still talking enough of a positive story that the analysts say, well, we still expect, therefore, this company to generate earnings. And there's just one little thing that I really understand it. It's that the companies with the largest earnings growth numbers are from companies whose revenues derived more than 50% outside the US. So I haven't figured that out yet, because I look outside the US and everyone's not growing. So where do these earnings come? I just don't know. I mean, maybe it's subsidiaries and stuff like that, but it's funny. But the companies which are showing the largest earnings increases, this 10% this year, 15% next year, the companies who make up that sort of number are majority-wise those companies whose earnings come mainly outside the US.
Maybe it's the old Enron game.
Oh,
But let me just explain what the old Enron game is. What Enron did, they had entities which they actually owned. They bought their products. The mother company put huge earnings into their balance sheet. But they actually did not really exist. We're not naming any names, but that is an explanation, because somehow you would see the footprint. We were talking about that Taiwan semiconductors who are producing the shit. NVIDIA is actually selling. We have to see that somewhere eventually in marketplaces. And we brought the European economy in, we brought the Japanese economy in, we brought the Chinese economy in. Who's buying?
The people are investing. And investing means that they're sort of spending money for the next X number of years. And this is the thing that really does surprise me, is because if all of this spending is on investments, it's a bit of a stretch for an analyst to say that, you're going to start to see benefits from next year, because that's a phenomenal increase in earnings expectation. It does kind of surprise me that we are seeing such a huge rise in expected earnings for next year. I'm not an analyst, and I don't do this sort of bottom-up thing where you do your DCF calculation on every company and then kind of work out what the S&P is. I've done that once for a client. But I'm really surprised in the current environment that people are still so positive about earnings. But understand that whilst the analyst expectations are still up there, they have not been shaken by whatever we've seen in terms of employment numbers and data and weekly things that sort of, it doesn't work like that. But, they've not been shaken by what they've seen. And these guys see it long before the data comes out. So if they're still positive.
They also don't want to see it, Intel slaughtered after the last earnings. Outlook not really encouraging, and they want to fire 1,500 people worldwide. Fine. We in Germany just subsidized Intel with a new factory in Magdeburg for 8 billion euros or something like that.
Why do you think they did the deal with you? When desperate people sign a deal, they're desperate. Okay.
Yeah, you can say that. They go for the cash, not for the idea behind it.
Nobody else is going to give them the money. It's cheap money for them. They can't go, they're not going to go into the equity market and do a capital raise, in the sort of ahead of earnings, which they know are shit, or the outlook is poor. So they go to the government and say, would you fancy doing a deal? And the government says, they want to do a deal with us. We'll do that. Yeah. Only 8 billion.
So undercover, you agree with me, earnings are becoming a big point. The pinpricks are in the employment figures. And we are all looking for the footprints. Yes, I totally agree with you. It's investment, but these investments in this high technology have to eventually convert into earnings with other companies. And there seems to be also a lack. We've seen it before in the 2000s. The internet was invented, bloody awesome. But not a lot of those companies who were at the time being praised as the second coming of Christ don't even exist today anymore. A couple were left over who were able to monetize that. And these were the mega stocks we all talk about now, who were able to really transfer that. And I think we're at the same period now. It's very difficult to pick the winners who will eventually transform these investments into real earnings in the future. And then you have the growth rates. Then earnings multiples will have to contract. And we haven't seen big contraction yet in the market.
This is right. I mean, this is where your eyeball should be on, and not some weekly sort of employment thing, which is going to be revised, later. That's just sort of part of the mindset of people's psychology in trading today. So, but it's important to look at what the CEOs think for their companies going forward. And at the moment, it looks as though they are not negative enough to, on the whole, anyway, to put a dent in where the kind of the market is today. Okay, so therefore I'll be disappointed. It's not the first time, but we've got a big number coming up. We've got Nvidia's sort of outlook. We want to hear about that.
What about last question for you? Next week, CPI, PPI.
I've long not looked at PPI and CPI in this respect, from a month-to-month basis. I think the general trend is very important to understand those general trends. The general trend has been down. So when it was 9% and then it was 8.7%, or then it was, those are sort of things that I think should grab your attention. But whether it's 3.1 or 3.3 or 2. I don't care. The general trend was down. We are in a general trend of flattening right now.
Yeah.
And it will take some time before this general trend of potentially going up happens. And I don't think it's going to be from one data point to the next. So, I'd much rather these long-term forecasts on things like CPI rather than the individual numbers. It's great for people who are running positions and, play a little bit of psychology and then they say, down 0.1. Are you serious? If you're running your positions on that basis, then you should give up, really. So, as you know, I'm not really a fan of these sort of news things generally, and it shouldn't influence people because the longer term picture on what's happening with inflation, I think, is clear. It's clearly bottomed out. And the only thing that I think will, what's holding it up at the moment is wage rises. And I can't see any politician who's not going to support people to get wage rises. Therefore, accept it's going to be 3% plus. And if it's going to be 3% plus, what am I doing buying 10 years at 3 point whatever it is? Yeah. Get here for a trade, buy it, get it out of the portfolio.
So, and before I open another can of worms, I just want to throw the word in Germany, we have already stagflation by definition. Yeah, inflation is going up and economy is going down. Think about that while we let you go for an amazing trading week next week. Probably it's going to be boring as hell after what we've seen. But I can only say thank you very much, Nic. That was enlightening as always, especially your take on Japan. And if you're not a big fan of our podcast, you're not listening to that anyway, but if you're a big fan, you've heard it before. Yeah, and I think Nic was one of the first guys actually to draw the attention to these points. I just want to rub the nail in because I haven't heard it from anybody else before you started talking about it, and then all the other pundits jumped on it as well. So thank you for that, Nic, and let me give you the last word before I say goodbye.
Have a nice week.
Have a nice week. Bye-bye.
See you. Bye-bye.